The Federal Reserve, as expected, raised interest rates this past week by 1/4 percentage point from 2 to 2.25%. It is the third interest rate hike this year, and it is the third of 4 expected increases this year, with 3 more to come in 2019, we expect. We did see a soft week for equities as a result. Joining me right now to talk about that and what is ahead is Strategas Securities CEO Jason Trennert. Jason, it's great to see you.
Great to be here.
You expected the Fed to raise rates, right?
We did. I think everybody did, and I think everyone expects the Fed to raise again in December. I think the question is how many times they'll tighten next year. My own opinion, they're slotting 4. In my opinion, that would be too many, mainly because inflationary expectations and inflation is still quite calm. But by the same token, I think this is a very good process because you're getting the Fed out of the way. You're using more than just monetary policy to stimulate the economy.
I agree, and the economy has been so great. Later, we'll talk with Nouriel Roubini, who is on the other side of this trade. But I will say this: we are expecting third quarter earnings to be up 22%, could be 25%. Third quarter earnings begin flowing next week. Of course, this weekend is the last trading day of the third quarter. So what are you expecting the rest of the year to look like?
Well, listen, I think the consensus view on Wall Street right now and among a lot of people is that we're in the late innings of the business cycle. And the most non-consensus view we have is that we might be in the middle innings. We might be in the 5th inning, not the 7th inning. And that's because I think the supply side impacts of the tax cut have not yet been fully seen. And that, by particularly say supply side, that means the reaction of businesses in terms of capital spending and hiring. So the earnings picture couldn't be much better. Right now, even with the Fed raising rates, the real Fed funds rate is barely positive, which means that the Fed is still very accommodative. So I think there's a lot more to go in both the bull market and in the business cycle. So the news is going to be good. I do think investors are going to have to be a little bit more choosy because interest rates are going to rise and the correlations between stocks are not going to be as good. But I do think it's going to be a very good period for both the economy and the markets.
I think I agree with you. We just saw another revision to the GDP, and it was 4.2% growth. Yeah. We had a great third quarter in terms of growth, and we're expecting earnings to back it up. Now, one thing was this economic policy out of the Trump administration, which I think is really underreported, is the rollback in regulations. And doesn't that correlate exactly to CapEx spending and businesses investing in their companies and the economy?
Well, the one thing that is undeniable, regardless of what side of the political aisle you're on, is that business confidence, small business confidence and business roundtable, big company CEO roundtable confidence spiked after the election and has stayed very, very high. And so that bodes very, very well when you have profits that are up 22%, as you said, for the third quarter, very likely, and you have business confidence that's high. Businesses make more investments, they hire more people. So in my opinion, this is not over by a long shot, and hopefully we don't make any sort of self-inflicted errors, but the rollback in regulations, as you pointed out, is a big part of the reason why business confidence has been higher. It's not just the tax cuts, it's the fact that you're not, as a small business owner or myself, knowing that regulations won't be worse. That in and of itself is something that inspires confidence, and it makes you focus more on your business as opposed to keeping regulators happy or other people happy.
Right, which is why I think there's a long runway here in terms of the economic policy. Tell me how to invest in this environment. I mean, obviously, some valuations have gotten stretched, particularly within technology, elsewhere. How do you want to allocate capital, knowing that this backdrop is quite strong?
I think you want to be in some of the places. You talked about the deregulatory framework, and I would say 2 sectors that would benefit most from that would be financials and energy. And so we're overweight 4 sectors. There's 11 sectors, but we're overweight financials, energy, industrials, and technology. In my opinion, financials and energy will benefit the most from the deregulatory process that we're seeing. I think it's a very, very it's a very important policy goal to get the velocity of money up and get banks to lend quite a bit more. That's going to be very good for their earnings, and the stocks in both sectors are quite attractive.
Jason, it's great to see you.
It's great to be here.
Thank you so much. Jason Trennert.